we are live with another Quick Tip Tuesday. Today we're doing a little earlier because I'm at Triple Play, the real estate conference in Atlantic City. But I still want to give you that value, the Quick Tip Tuesday each and every Tuesday, 8 p.m. Eastern Time on the regular, but today's a little earlier. Today's topic is the tax benefits of real estate. Real estate has a lot of tax benefits. That's why a very high percentage of the wealthy own real estate because of the tax benefits. A lot of them pay minimum taxes because of the benefits it has to offer and the strategy that their people around them, their workers, help them to pay lower on taxes. Number one. In real estate, you can deduct a lot of your expenses. The taxes you pay, number one, it can decrease the profits or income you have. The insurance you pay, the management fees if you're not managing the property yourself, the cost to maintain the property, if there's any roof leaks, the maintenance, the pipe burst or a new boiler, new this, new that. There can be a lot of things within the repairs. All of those fall into that. If you pay for advertising, let's say, for instance, you need a new rental, you pay for advertising to get a new tenant, you can definitely write that off. But keep in mind, all of these expenses are if you're renting a property. But if you live in the property yourself and you're not renting it, there's not much tax benefits to it, because the reason behind it is because you're creating housing for others. And the United States is business. It basically tries to push for that, for more ownership and provide housing for others. That's why there's a lot of benefits of owning real estate. So you can definitely expense a lot of the items within if not all, of the items when you own real estate and the rentals you do have. So definitely keep that in mind. That's key. There's a lot of expenses that are paid throughout when you own real estate. Just make sure you keep a track record of that. You have proper receipts. Of course, speak with your accounting. Once you grow your business and you own more properties, you can definitely start thinking about having a CPA, get QuickBooks, or just track that information, because the more properties own, the more maintenance you're going to have, and you're not going to always remember. And you don't want to go at the end of the year to basically try to remember what you paid for in expenses and what you paid for this, the receipts over here, receipts over there. What expenses I'm not able to write off on my taxes. So for instance, if you live in the property, you can't, if you live in the one unit, of course, you cannot expense anything that you repaired in that unit. But everything on the other side, yes, you can. You can expense everything that you repaired, you fixed, in the roof. There's definitely guidelines. Speak to a CPA on the percentages and what you cannot write off if you live on the property. But if you do not live on the property and it's 100% rental, you can basically expense anything you've done on the property. When it comes to meals and different things like that, I know every year tax differs, so definitely keep that in mind. Let's see. Yeah, so real estate is amazing. Expenses, number one. What is cost segregation? Oh, that's a good question. That's actually one of the topics I was going to discuss, the benefits of real estate. So cost segregation is like an acceleration of depreciation, kind of, you can say. That's one of the highly used for higher incomes that people want to basically reduce their taxable income. What cost segregation does, there's basically an analysis, someone that goes to the property you own, and they highlight every piece of item within that property, for you can do a higher tax deduction for that year. So if you bought the home that specific year, you can do a cost segregation that year, and you can do an actual higher deduction and reduce the taxable income at the end, reducing what you pay in taxes. Besides from that, there's something called depreciation. So depreciation is a little different. Depreciation is a set number. whatever you paid for the property for residential, you can basically take that number. Let's say you bought a property for $275,000. They would allow you to take that depreciation for 27 and a half years. So every year you can take that deduction to reduce your taxable income. So 275 divided by 27 and a half to make it easy, that's 10,000. So every year you can reduce your taxable income by 10,000. And the difference between both cost segregation and depreciation is a set amount. No analyst or no one has to go to the property. You can definitely do a one shot. And then for commercial, I believe it's 30 or 32 years for the depreciation. When it comes to cost segregation, it's a little more advanced, but it's definitely is utilized for the higher incomes, and I would definitely recommend it if you're getting into the higher income brackets, because you're able to reduce your taxable income more, and you can do it on the first year. So a lot of people definitely, instead of taking the 10,000, you could probably take 100,000, 120, 150, and that can definitely help you on the tax side. So the next one is a pass-through deduction. So let's say another benefit is you own real estate with an LLC, and when you do your taxes, you're passing it through to your personal name, and you put it on your personal taxes. You can basically take another deduction, which is, I believe, the QBI, qualified business income. Don't quote me on that. The definition. The name, you can take another deduction of 20% on top of that. So that would help you even more to reduce your taxable income. Other benefits within real estate is appreciation. Real estate appreciates over time. So this is what happens with real estate over time. Of course, there's something, sometimes it can go flat or go a little drop. But if you look at the history over time, it goes up. So that's huge. You're paying down when it appreciates, you build equity, as well as when you make your monthly payments to a mortgage, you're paying down the loan. At the end of the day, is increasing your equity. So that's huge. You're getting equity over time. If you don't have a loan on the property, of course, there's no payments to a loan, but you still have to pay your taxes and insurance, which you still can write off with that. When you're getting ready to sell your real estate, you can do a 1031 exchange. That can be a whole nother topic. Basically, you can avoid paying the capital gains on the property. You can use the profits and transfer to another property of equal or greater value. There's a lot of experts with 1031s. I would definitely recommend speaking to a true expert on that, because it can get complicated. A good title rep, an attorney, or someone can definitely guide you in the right direction on making sure you're making that 1031 properly to avoid paying taxes. Well, delaying, you're pushing it more further, because if you sell that property or do another 1031 exchange, you're just delaying the taxes. But there's definitely good strategies on helping you avoid. There's another benefit that the government gives, an opportunity zone. So there's definitely certain areas where you can buy property, like lower income, and they want you to build that community, and they would defer capital gains taxes to a certain year. I believe the current one is 2026. I can keep going on and on regarding the benefits of real estate and the tax benefits, but those are the top items. Each item can have subcategories, but I want to keep this short and sweet. Thank you, everyone, for the questions. If you have any topics for me to discuss next week's Quick Tip Tuesday, please let me know. All right, and have a great rest of your Tuesday.